Did you know that a book could be your best investment? The Intelligent Investor not only changed the way I invested, it changed my life. Today I want to share with you something very special. How Benjamin Graham's book, The Intelligent Investor, completely transformed my approach to investing and managing my wealth. This book is considered the Bible of investing by Warren Buffett and has guided generations of investors. First published in 1949, The Intelligent Investor has remained an essential guide to investing. Benjamin Graham, its author, is known as the father of value investing. Through its pages, Graham not only shares investment strategies, but also fundamental principles that have stood the test of time. His teachings remain relevant even in today's complex financial world. For me, this book was a revelation. It changed my focus from looking for quick profits to developing a solid, long-term investment strategy. It taught me to be patient, to analyze deeply, and not to get carried away by the emotions of the market. In this video, I will share with you the most valuable lessons I learned and how you can apply them to transform your investments and your financial life. Graham makes a crucial difference between investing and speculation. While speculation focuses on short-term gains, often with high risk, investing is based on rigorous analysis and a long-term vision. Following this principle means seeking stability and sustainable returns rather than the quick, often ephemeral, success of speculation. The concept of margin of safety is fundamental to Graham's philosophy. It refers to investing with a cushion that protects against miscalculations or unforeseen events. This means purchasing assets when their price is significantly below their estimated intrinsic value, thus providing greater security in the investment. This approach reduces risk and enhances profit opportunities. Graham also highlights the importance of diversifying your portfolio. It's not just about reducing risk through variety, but also about balancing different types of assets that react differently to the same economic conditions. A diversified portfolio can help protect your investments from unpredictable market fluctuations and maintain constant growth. In my experience, applying these Graham principles has been crucial. For example, by focusing on stocks with a margin of safety, I have minimized my losses during market declines. Diversification, on the other hand, has balanced my portfolio in different economic situations at any given time, thus reducing its volatility. In addition to financial principles, Graham focuses on investor psychology. Let's look at how our emotions and behaviors affect our investment decisions. He describes this very well with the Mr. Market metaphor, which is a powerful conceptual tool to understand the behavior of the stock market. Graham personifies the market as Mr. Market, an entity that offers stock prices daily, fluctuating between irrationality and logic. The phrase, Mr. Market, is a schizophrenic in the short term who regains his sanity in the long term. Illustrates how the market can behave erratically and emotionally in the short term, influenced by panic, overconfidence, or reactions to recent events. However, in the long term, the market tends to more rationally reflect the underlying value of companies, adjusting to their true intrinsic value. This metaphor is essential for investors who follow Graham's philosophy, as it underlines the importance of maintaining a long-term perspective and not getting carried away by daily market fluctuations. By focusing on the long-term value and fundamental quality of an investment, rather than the market's overreactions and often emotional reactions, investors can make more informed, less reactive decisions. Additionally, it emphasizes the importance of character and emotional control in investing. These two sentences clearly reflect that perspective. The phrase, financial intelligence is more of a character trait than a brain trait, suggests that investment success depends not so much on intellectual intelligence or technical knowledge as on a person's character. This implies that qualities such as patience, discipline, perseverance, and the ability to stick to a long-term strategy, even in the face of market fluctuations, are crucial. Financial intelligence, therefore, is more about how you manage your emotions and reactions, how you stick to your investment principles and strategies, and how you resist the temptation to follow passing trends or make impulsive decisions. Another sentence. People who cannot control their emotions are not suitable for making profits through investment, further emphasizes the importance of emotional control. Investing can often be an emotional journey, with market fluctuations causing euphoria or panic. The inability to control these emotions can lead to rash decisions, such as panic selling during a market crash or excessive buying during a market bubble. Emotional control is therefore essential to maintain a rational perspective and make investment decisions based on analysis and facts, rather than impulsive reactions. Together, these phrases highlight the importance of strength of character and self-control in the world of investing, remembering that true financial wisdom goes beyond mere technical knowledge. We continue with another important aspect: resisting herd behavior. You will not be right or wrong because the crowd does not agree with you. You will be right because your data and your reasoning are correct, underlines a fundamental principle in investing: the importance of independence and rationality in decision-making. This statement challenges the human tendency to follow herd behavior, a common phenomenon in financial markets where investors tend to follow the opinions of the majority. Graham points out that majority agreement or disagreement is not a reliable indicator of the correctness of an investment decision. Instead, he suggests that the accuracy and validity of information and logical analysis are what determine whether an investment is wise or not. This implies that even if the majority of people disagree with a given investment decision, this does not automatically make it wrong. The essence of this statement is the encouragement of independent, critical, and analytical thinking in investing. It implies that investors should not base their decisions on what is popular or trending, but rather on detailed analysis and verifiable data. Thus, Graham promotes an approach to the world of investments that values diligence, in-depth research, and logical reasoning over emotions or fads. This perspective is particularly relevant in a world where information flows rapidly and the opinions of the majority can be easily influenced by irrational factors. Taking an evidence-based approach and critical analysis is essential for long-term investment success. Personally, I have had to learn to manage my emotions in investing. I have experienced moments of uncertainty where resisting impulsive stock selling was challenging, but by sticking to my analysis-based strategy, I managed to overcome those moments and make profits in the long term. Before continuing, if you like this video, leave a like and subscribe. This way you can continue enjoying more content like this. Let's continue. With the right mindset established, let's now explore the specific stock investing strategies Graham recommends. One of Graham's strongest recommendations is fundamental analysis. This approach involves evaluating the intrinsic value of a company, considering its assets, earnings, dividends, and growth prospects. Graham advises investing in companies whose shares are selling below their calculated intrinsic value. This method requires thorough research and a deep understanding of the company, its industry, and its market position. Graham often favored companies with boring stories, that is, established, profitable companies with simple, understandable business models. These companies may not be frequent headlines, but they often offer strong, consistent returns. The idea is to invest in businesses that you understand well, and that show a history of stability and profitability, rather than chasing the latest trends or fads in the market. Applying Graham's principles, we should look for companies with a solid financial position, little debt, and a history of consistent profits and dividends. For example, companies in sectors such as consumer goods, utilities, or healthcare often offer this stability. Additionally, I prefer companies that have a clear dividend policy, which indicates prudent financial management and a commitment to shareholders. These choices have aligned well with the philosophy of seeking long-term value and have contributed to strength and resilience of my investment portfolio. Beyond stocks, Graham also shared his wisdom on bond investments. While stocks often get the attention in investing, Graham emphasizes the importance of bonds. Let's look at why and how you can integrate them into your investment strategy. Graham highlights that bonds can be a crucial part of any diversified portfolio, especially as a way to reduce risk. Bonds, particularly high-quality government and corporate bonds, provide stable income through interest payments and tend to be less volatile than stocks. The inclusion of bonds can help balance stock market fluctuations, providing a more predictable source of income and a cushion during times of market uncertainty. When investing in bonds, Graham advises analyzing their credit quality, which indicates the issuer's ability to pay interest and principal. Bonds with higher ratings, such as AAA, have a lower risk of default. Additionally, it is important to consider the yield of the bond, which must be adequate to offset inflation and credit risks. Understanding the duration of the bond is also crucial, as it affects the sensitivity of the bond to changes in interest rates. Following Graham's advice, I have personally included bonds in my portfolio to add stability and reduce overall volatility. When selecting bonds, I have focused on those with strong credit ratings and avoided junk bonds with high but risky yields. This strategy has allowed me to have a steady income stream, supplementing my stock investments and providing a cushion during stock market declines. With a clear understanding of how and why to include bonds in your portfolio, let's now move on to discuss specific tips for young and beginning investors, as taught by Graham. Investing can seem overwhelming, especially if you are young or new to the world of finance. Here are some tips to get started on the right foot. Graham emphasizes the importance of starting investing at a young age. The power of compound interest is one of the most powerful financial tools at your disposal. Investing even small amounts regularly can add up significantly over time. For young investors, this means that starting early can result in substantial wealth accumulation, making the most of time to allow your investments to grow. Graham advises taking a long-term investment approach, seeking stability and avoiding speculation. For beginners, this means focusing on building a diversified portfolio that can withstand market fluctuations. This could include a mix of stable stocks, bonds, and perhaps index funds. The goal is not to look for quick profits, but to gradually build a solid and stable asset over time. For novice investors, The Intelligent Investor offers a solid foundation on which to build your understanding of investing. The book highlights the importance of analysis and diligence and advises against getting carried away by market fads or panics. By adopting Graham's principles, new investors can develop a critical mindset and methodical approach to investing, helping them make informed and responsible financial decisions. Reflecting on The Intelligent Investor by Benjamin Graham offers us not only investment strategies, but valuable life lessons. The book teaches us that successful investing requires patience, discipline, and continued education. We can apply these lessons in our daily lives by taking a long-term approach to our financial decisions. This means living within our means, saving and investing regularly, and avoiding unnecessary debt. It also means continuing to educate ourselves financially, staying up to date on markets and economic trends, and seeking advice when necessary. These habits will not only strengthen our financial health, but will also give us greater peace of mind and security. To conclude, I will quote a phrase from the book that summarizes very well the behavior of a successful investor. The market is like a pendulum that always swings between unsustainable optimism, making assets too expensive, and unwarranted pessimism, making assets too cheap. The intelligent investor is a realistic person who sells to optimists and buys to pessimists. I hope this journey through The Intelligent Investor has inspired you. If you like the video, don't forget to like it, subscribe for more content, and share your own experiences in the comments. See you next time.